Hello everyone and welcome back to the revisionary sessions on derivatives. So friends, this is the second class on the derivative revision, and if you can recall, in the first class we have learnt the concept of arbitrage through futures. In this class we are going to focus on hedging through futures. When we talk about hedging, what is the meaning of hedging? Hedging is basically a risk management technique. You have made an investment and now you definitely get the risk of that investment. Obviously, investments are subject to market risk, you know it very well. So once you have already taken the risk, how to manage that risk, that comes under hedging. So these being revisionary classes, I will be having a pinpoint focus from the viewpoint of revisions only. So hedging with futures can be classified into four categories: hedging with stock futures, hedging with index futures, hedging with commodity futures, and hedging with currency futures. The last part, hedging with currency futures, it is involving the foreign exchange risk management technique basically. So it is hedging of foreign exchange risk through currency futures. This part, that is the hedging through currency futures, it involves foreign exchange risk management also, and therefore I will be covering that aspect separately in other session. In this session I am focusing on the other three aspects, that is hedging through stock futures, hedging through index futures, and hedging through commodity futures. So what are stock futures? These are futures contract where the underlying is any stock. Suppose you hold stock of X Limited and there is a futures contract available on the stock of X Limited. That means there is a futures contract available with the underlying as stock of X Limited. Then the futures of X Limited can be used for hedging the risk of stock of X Limited. Let me elaborately explain this point. Suppose you have purchased the stock of X Limited with an objective of holding it for a substantial period of time. However, in the near future you are expecting a short decline. If you do nothing, your wealth definitely gets reduced. But because your objective is to hold it for a long time, you don't even want to sell it. So point is clear. Selling the stock is not the lookout or not the way out or not the objective that we have. So someone would say, if you are having risk of reduced value that on the stock that you are holding, simply sell it off. But selling that stock is not our objective. Let me be very clear, selling the stock is not our objective. We continue to hold the stock and still would want to manage the risk, and that is why we are looking into hedging. That is why we would resort to stock futures. Now friends, the earlier chapters that I have covered, the earlier videos that I have covered on derivative basics and derivative revisions, if you have not watched those earlier videos, there will be a little problem in understanding what I am conveying. So I have given the links of those videos just below this video, and you should watch those videos necessarily if you haven't, and then only continue from here. I am assuming that you have watched both of those videos, and therefore after covering that basics and the revision first part, we can continue over here. So in the basic part, we have learnt that when there is a stock future available, there is a futures contract on a particular stock available, and you take a short position on that stock futures, you will be able to get that much wealth in hand, which is based on the price of that futures. We have learned this already. So now what we would do is we would use this as an opportunity to hedge the risk of the stock that we are holding. So friends, let me explain this by way of an example so that you get much better understanding. Consider a situation that there is a stock, price of which is expected to decline. So what you find on the screen is the expected price movement. I repeat, it is the expected price movement. Currently, the price of the stock is rupees 490. So you can consider that presently the stock is having this price range, that is 490, and it is expected that in the coming time the price would decline. So what is this 490? 490 is the current price of the stock. With this expected decline, the price would land up over here maybe in 3 months time. So this price level is definitely lower than this one. So assume that this price level is 420. So expected price of the stock after 3 months will be declining from 490 to 420. That means there is an expected loss of rupees 70. Now how do you manage this situation? First thing, anyone would say sell the stock at this price so that you don't get the hit of this decline. But as I told you earlier, selling the stock is not our objective at all. If we don't have to sell the stock right now, we need to look into the ways in which we can manage the risk of this stock. So we have looked upon at the 3-month futures contract of this same stock, and the 3-month futures contract is quoted at rupees 500. You know one thing, that the futures price would be slightly higher than the spot price. Spot price is 490, 3-month futures price would be suppose 500. Now if you enter into this futures contract with a short position, so what will happen? Entering into this contract with a short position will result in a wealth of rupees 500 after 3 months. Now friends, I have explained this root concept logically in my earlier videos, that if you are entering into a short position in a futures contract which has the contracted price as rupees 500, then over 3 months time, irrespective of what changes occur in the price of the stock, you would not get the hit at all. You will be able to sell the stock, you will be able to encash rupees 500, and that 500 is nothing but the futures price. That is the price of the stock in the futures contract. You can consider as if it is a contracted price, and you are entering into a contract to sell the stock at rupees 500. So what will happen? After 3 months, irrespective of the price of the stock, you will be able to sell it for rupees 500. How this works in reality through margin mechanism in futures, I have explained this concept in the first part of the derivative, that is the basics of derivative. So if you haven't watched the video, please watch it before you take things further. Otherwise there will be lots of confusions throughout the video that you see ahead. So let me take you back to the example, and what we find after this, you would see that from this contract, if you are now selling the stock at 500 where the expected market price is just rupees 420, you will make a gain of 500 minus 420, that is rupees 80, and that gain of rupees 80 will offset this expected loss of rupees 70. In fact, you will end up making still a net gain of a small value, that would be rupees 10, and that is basically the difference between the spot price and the futures price. So friends, I have asked you to take note of this. You should simply pause the video if you want to write it down, and if you want to continue ahead, just continue with me. So I believe you are done with the writing work. Let us move ahead and now talk about the next concept, that is concept number 11, hedging through index futures. Now friends, you should understand one simple thing. You may not be so lucky to have all the stocks in which you are trading, should have their futures contract. Now if you could see in National Stock Exchange, NSE, there would be around 1600 securities that are traded. Okay, now do you expect that for all those securities which are listed with NSE, there will be a futures contract? It may not happen. There will be limited number of securities on which the futures contract would exist. So suppose you hold stock of X Limited and you have a futures contract in the FNO market available, you can definitely plan your hedge through that. But what if there is no possibility of a futures contract of that particular stock? In that case, you cannot hedge the stock risk through stock futures, and then you have to rely on the next category of hedging, that is hedging through index futures. Now when we talk about hedging through index futures, you may use the contract of Nifty futures to hedge the risk of your stock, and therefore there has to be a connecting point between your stock and Nifty, or your stock and the Nifty futures. And you have learned one thing in the portfolio chapter: beta is the factor that relates the risk of a stock with the stock or stock futures. So there has to be a beta computation getting involved, and if you can relate your stock risk with the Nifty's risk or with the Nifty futures risk, you will be able to identify the relationship between the two, and you can plan your hedge through index futures, or in this example what I have just mentioned, you can plan your hedge through Nifty futures. So how this would work, let us understand this with a calculative example. Let me take you to a calculative example in this regard, and that is given under question number 16. So please carefully read this question and try to understand. Mr. X holds 4,000 equity shares of A Limited. Such shares are currently priced at rupees 400 per share. The correlation of equity share of A Limited with Nifty futures is 0.8. Standard deviation of A's stock equals to 6%. Standard deviation of Nifty is given as 4%. 3-month Nifty futures is quoted at rupees 8,000. You are required to explain how the investor can create a perfect hedge. What will be the outcome after 3 months if the share price falls to rupees 340 per share, and in the second case it is given if the share price rises to rupees 448 per share. Now friends, when we have to solve a question like this, there will be a specific procedure that you will have to follow. Specific procedure will include 5 steps. Let me first explain those 5 steps before you start attempting the solution. The very first step would be identify what is the total value of the portfolio that you want to hedge. For that purpose, you just have to look into what are the number of shares that you are holding and what is the current value per share. So number of shares that you are currently holding multiplied by current value per share, that will give you the value of your portfolio that you want to hedge. First identify that. Second step, what you do is determine the beta of the stock. For computing beta, you need the standard deviation of the stock, you need the standard deviation of Nifty or whichever index through which you are hedging, and you also need the correlation between the stock and the Nifty or the stock and the Nifty futures. When you have this information, you can easily determine beta. Once you determine beta, then compute in the third step the value of index futures contract that you should negotiate. In other words, you determine what should be the value or desired value of index futures for the purpose of hedging. And to compute that, the task is very simple. You may simply take the stock value that you are holding. In the first step, whatever you have computed as the value of your portfolio, that value of your stock portfolio multiplied by beta will give you the desired value of index future contract where you should take short position. Then look into what is the price of index future given, and through which you can identify the number of indices that you should contract. Once you identify all this, in the fifth and last step, you would just compare the outcome of the two situations over here with all the possibilities, and you should show how you have successfully created a hedge. That means irrespective of the fact whether the price rises or falls, you are not at risk at all. That is what we have to learn over here through this calculative example. And let us do one thing now. Let us look into how to present the solution for the same. So in the solution, you would begin with determining the value of stock portfolio at present. So in this case, the number of shares will be multiplied to spot price per share, which we have as 4,000 shares multiplied by rupees 400 per share. That means the investor has a total investment portfolio of rupees 16 lakhs. Next step would be to determine beta. Now we know how to determine beta. We have learned this. Beta of x will be standard deviation of x divided by standard deviation of index, that is standard deviation of market, and multiplied to correlation between x and market. Here we have beta of company A to be determined, and that is to be computed by taking 6 divided by 4 into 0.8, and that gives you 1.2. Friends, I would recommend that you please write down this much and then I explain you the matter ahead. So the next thing in the solution, that is step 3, you will determine the desired value of index future portfolio, and desired value of index future portfolio will be value of stock portfolio multiplied by beta, that is 16 lakhs multiplied by 1.2, and that gives you rupees 19,20,000. What I have just mentioned, you have to enter into a Nifty futures contract with a short position, and the contract value of Nifty futures has to be targeted at 19,20,000. Quickly take note of this and then I take you ahead. Alright friends, let us move ahead, and the next step, that is step 4, is determine the number of index futures to be contracted. So number of index futures to be contracted will be desired value of index future that we have just determined 19,20,000 will be divided by the index future price, and mind it, index future price given to you already in the question is 8,000 rupees. So it will be 19,20,000 divided by 8,000, 240 indices. That means what you should do, Mr. X should enter into a Nifty futures contract for 240 units with a short position. So please write down this also and then we move ahead. Alright friends, you would have finished writing this as well. So in the next and last step, what we are going to do, the two scenarios given to you, we are going to analyze each of these. So step 5, we determine the outcome of the scenario based on the given information. So outcome of case 1, stock portfolio with long position. So what we have is value today from the first step, rupees 16 lakhs, value after 3 months. Now this is expected to be rupees 340 per share. What is rupees 400 now is expected to become rupees 340. As a result, your overall stock portfolio value is expected to decline from 16 lakhs to 13 lakhs 60,000. And if that happens, the resulting loss on the stock portfolio would be rupees 2,40,000. So this 2,40,000 is the loss from the stock portfolio, but this is not the ultimate amount of loss. This is just the outcome of holding this stock portfolio. We have yet to consider what happened with the Nifty futures contract. So before I show you that, please take note of this much. Alright friends, you would have written this much. Let us proceed ahead. So what we see next is the outcome of short position in index future portfolio. So most important thing is price of index future after 3 months. This is going to be rupees 7,000 as per our expectation. How did we arrive at this 7,000? I am going to explain you in a while, because that has been presented via working note number 1. So just hold on a little. I'll explain you how we got this 7,000. But if you look into, you have entered into a contract with a short position, means you have entered into a contract to sell at rupees 8,000, and on the settlement date the price of Nifty futures turns to be 7,000. So something that you have agreed to sell at 8,000 is actually prevailing in the market at rupees 7,000. Obviously you are selling at a higher price and eventually making a profit. So gain per index is rupees 1,000, and the number of indices that you have contracted is 240 index. So the resulting gain is rupees 2,40,000. What we find, the net gain or loss, that is on stock portfolio and index future portfolio, when offset we get nil amount, that means we have successfully planned the hedge position. Because the overall resulting gain or loss is nil, we are calling this as a perfect hedge. Please take note of this and then we move ahead. Alright friends, I am sure you would have finished writing this whole thing. One thing that is left over is to understand how did we get rupees 7,000 as the expected price of Nifty futures after 3 months. So for that, I told you earlier, we are going to make a separate working, and I am also going to explain that working to you. Let us move ahead and understand and write it down. So we first find the decrease in share price. You observe that the price of the share 3 months before was 400 and the share price after 3 months is 340. 400 becoming 340 means the decline is by rupees 60. Rupees 60 decline on the base price of 400 shows a decline of 15%. Now we know one thing, that percentage decrease in the share price will be percentage decrease in index multiplied by beta. Why? Understand this equation, something very important. What is the meaning of beta? Beta indicates the degree of risk that your stock has with respect to the Nifty futures. So in this case, beta is 1.2. Whatever be the movement in index future multiplied by 1.2 should be the movement in the share price. As a result, if this is 15% and this is 1.2, what will be the percentage decrease in index? So we can work out this equation by substituting percentage decrease in share price as 15% and beta as 1.2. So what we get is percentage decrease in index as 12.5%. Therefore, index future price after 3 months will be, it was originally 8,000 and reduced by 12.5%, which gives you a final value of rupees 7,000. Please take note of this and then we move ahead. Alright friends, after noting down this whole thing, let us conclude one more point as a formula over here. If you would want to arrive at percentage decrease in index directly, you may take the percentage decrease in stock divided by beta and you will get the percentage decrease in index directly. So let us write down that small notation so that it can be used directly in calculations ahead. So what I want you to write down is percentage decrease in index equals to percentage decrease in share price divided by beta. This decrease and decrease can also be increase and increase, because beta being positive, obviously the stock and index both are going to move in the same direction. And now let us go ahead with the outcome of case 2. In case 2, what has happened, that the share price has been expected to increase. So value at the initial stage was 16 lakhs and value after 3 months from 400, the share price is expected to rise to 448. So from 400, if it has become 448, the total value of your stock portfolio becomes 17,92,000, resulting into a gain of 1,92,000. However, this index future portfolio is not going to allow you to enjoy this gain, because one side, if you have made gain in your stock portfolio, your Nifty futures contract will obviously result into a loss. That is the negative aspect of creating hedge position. It will not let you earn profit. On the other side, it will not let you incur loss also. So please take note of this and then we move ahead. Alright friends, moving ahead, what we observe now with respect to Nifty futures portfolio, that is what we call as index future portfolio. The price after 3 months, again we have expected the price to be 8,800. How we got 8,800? Again we are going to show by a separate working as working note number 2. So contracted sale price was 8,000 and the resulting price after 3 months, when the time of settlement arrives, it is expected to be 8,800. That means you have agreed to sell something at 8,000 whose price has eventually become 8,800. That means you are trying to sell it at a lower price. Moreover, if you have taken a short position in anything and after taking short position, if the price rises, obviously you are going to incur loss. So now there will be a loss per index of rupees 800, and the number of indices that you have contracted is 240 index. Resulting loss over here will be exactly the same amount, that is 1,92,000. This gives you again net gain or loss as nil. So again, what we have planned is a perfect hedge. Please take note of this and then we move ahead. Alright friends, let us move ahead and understand how did we get this expected price of Nifty futures after 3 months as 8,800 via working note number 2. So we have already understood one thing, that percentage increase in the share price from 400 to 448, it indicates a 12% increase. We have also learnt a notation that percentage change in index will be percentage change in stock divided by beta. Directly applying this notation, it will be 12 divided by 1.2, that gives you 10%. And when this 10% increase added to the initial price of the Nifty futures, that is 8,000 plus 10%, it will eventually become 8,800. Please take note of this and then we move ahead. Alright friends, you would have finished writing this whole thing as well. Let us move ahead and discuss the next concept, and that would be hedging with commodity futures. Let me now explain what exactly is this. It is not necessary that you always invest in stocks. What if you have invested in commodities? If you have invested in commodities and would want to hedge the risk of those commodities, suppose you have invested in gold and you are expecting the price of gold to decline in this coming future. So you may take a gold futures contract. So there is a separate market known as commodity market, and there are futures contract available even on commodities. Gold futures, copper futures, futures contracts are available even on food grains and necessary commodities. As a result, in the commodity market also there are commodity derivatives, and through these commodity derivatives, particularly through commodity futures, you can hedge the risk of the commodity that you are holding. This is the concept that we would first cover up along with a calculative example. In fact, the entire understanding I will make you clear with through that example itself. So once you have learned hedging with index futures, learning commodity futures will be no big deal, because more or less the procedure would be same. Now, what is needed? Simply you need to do one thing, that after we are done with this concept of commodity futures, we will have some more practice questions on stock futures and index futures, and that is all what we are going to cover up in this session. So let us begin with the calculative example on commodity futures. Let us take up question number 21 and just read the question. A company is long on 10 metric tons of copper at the rate of rupees 474 per kg spot and intends to remain so for the ensuing quarter. The standard deviation of changes in its spot and future prices are 4% and 6% respectively, having correlation coefficient of 0.75. What is its hedge ratio? What is the amount of copper future that the company should short to achieve a perfect hedge? So friends, basically let us try to analyze the question first. The company is long, that means company is holding stock of this copper, 10 metric tons of copper. Price of the copper at which the company has bought it is 474 per kg. You would want to convert this per kg value into total value in terms of 10 metric tons. Important thing is company intends to remain so. That means this company is not going to sell copper what it is holding right now. Because it is going to hold it, it is willing to enter into a copper future contract to hedge its position, and it is aiming at a perfect hedge. You are going to hedge the risk of copper held in spot market through the copper future contract. That means the instrument through which you are planning to hedge is copper future contract, and the commodity that you are hedging is the copper itself. So obviously we will require beta of copper future with respect to copper spot, and that is why you have been given standard deviation of both spot and futures, and you have been given correlation coefficient between the spot and futures market. So let us see how to proceed with the solution. In the solution, we would first mention the fact that the company requires a perfect hedge, and therefore the hedge ratio must match with beta. So you begin your solution by writing, in order to create a perfect hedge, the hedge ratio must match with beta. In this case, beta has to be the spot beta in relation to the futures price. So beta will be standard deviation of spot divided by standard deviation of futures multiplied by correlation between spot and futures prices. So you may write the meaning of these notations, and then we will find the beta of this spot with respect to the futures. So that beta comes to 4 by 6 into 0.75, and that is finally 0.5. So please take note of this, and then we move ahead. Alright friends, moving ahead, we would first determine the total value of copper held in spot. So what we do is, the quantity held is 10 metric tons. Each metric ton would be equivalent to 1000 kgs. So 10 into 1000 kgs, it would be in total 10,000 kgs, and that will be multiplied to the per kg price, that is 474. So 47,40,000 is the total value of copper held in the spot. Now the hedge ratio has to be 0.5. We have already mentioned this earlier, that in order to create a perfect hedge, the hedge ratio must match with beta, and beta was computed as 0.5. Therefore the desired value of copper futures will be the value of copper spot into hedge ratio, that will be rupees 47,40,000 multiplied by 0.5, that results into rupees 23,70,000. So the company should short 3-month copper futures for total target value of 23,70,000. Please take note of this as well, and that will be end of the solution. Alright friends, you would have finished writing this whole thing. Now let us recall what we have just discussed over here. We have learnt how to hedge with stock futures, how to hedge with index futures, how to hedge with commodity futures. We are definitely going to practice questions on the same. A few more examples that we will definitely practice. But before we step into those examples, the most interesting part of hedging with futures is hedging with currency futures. If you could see what comes in examination with highest repetitive frequency, is the concept of hedging through index futures and hedging through currency futures. Few times they have asked questions on commodity futures and stock futures. So from examination viewpoint, be very clear, the concept of index futures and currency futures happen to really more important than the others. Now friends, currency futures, you are not going to deal in an easygoing manner the way we have dealt with this part. It is little more extensive and lot of thinking work required with that, and therefore what I have done is, the entire discussion on hedging through currency futures I have covered in the upcoming videos, and the simplest thing that we have observed over here, whether it is holding stock or holding a commodity, you already have a long position with that stock or commodity. So for hedging, you have created a short position in the futures contract. In currency futures, you cannot blindly take a short position because the contract of currency futures could be having the underlying asset either as the local currency or as the foreign currency, and accordingly, depending on whether you are exporter or importer, you will have to plan your hedge very well. That is something very, very interesting, and don't forget to watch my video on currency futures and hedging through currency futures. So let us do one thing now. Let us practice some more examples on hedging through stock futures and index futures. Take up question number 15. Let us read this question. Mr. X holds 5,000 equity shares in NJ Limited. These shares are currently quoted at rupees 480 per share. The investor is willing to hold the shares for a considerable time and then sell these shares, which is expected to be much higher. In this plan of holding the shares and selling these later, the investor also has risk of loss. That is, if the price of the share falls below rupees 480 per share. Suppose a 6-month futures contract for shares of NJ Limited is quoted at rupees 492 per share. Explain how Mr. X can create a hedge by using stock futures. For this purpose, consider the following situations. Number 1, price of equity share falls to rupees 460 per share, and number 2, price of equity share rises to rupees 500 per share. So in this solution, we would first mention the fact of taking short position in the futures contract. You would write, in the given case, Mr. X can simply enter into a futures contract to sell 5,000 equity shares of NJ Limited after 6 months at the specified future price of 492 per share. Mind it, when we say enter into futures contract to sell, it eventually means taking a short position in the futures contract. By doing so, he would obtain a gain of 492 minus 480, that is rupees 12 per share, and in total gain of rupees 60,000, because he has a position size of 5,000 shares and per share there is a gain of rupees 12. So in total there will be a gain of rupees 60,000, and this will happen irrespective of the prevailing market price on the maturity date. And to demonstrate this, we are taking two different situations as given in the question, and I would want you to quickly write up this much and then we move ahead. Alright friends, let us move ahead and take up each of these situations one by one. So we start with situation 1, price of equity share falls to rupees 460 per share. So in the stock portfolio where the investor has taken a long position, what will happen? The value of the stock portfolio today is 5,000 shares multiplied by 480. That is rupees 24 lakhs. And what happens after 6 months? The value after 6 months will decline. 5,000 shares multiplied by 460, that is rupees 23 lakhs. Now important thing to notice over here, you have a long position. That means this is your asset, and your asset value today is 24 lakh. Your assets value after 6 months is expected to be rupees 23 lakhs, because the value of your investment, the value of your asset is declining. You will obviously incur a loss of rupees 1 lakh. Now how does this loss get offset? Through the futures contract. That is worth observing. So in the futures contract, first of all, you have taken a short position. Resulting gain will be 492 minus 460 multiplied by 5,000, that is 1,60,000. Let us try to understand this line. You have agreed to sell the share because you have taken short position. You have agreed to sell the share at rupees 492, whereas after 6 months the prevailing market price is 460. Something whose price is 460, you have agreed to sell the same at 492. That means you have made a profit of rupees 32 per share multiplied by 5,000 shares. Your overall profit is rupees 1,60,000. Now compare 1,60,000 of gain and here 1 lakh of loss. The net gain would be as 1,60,000 minus 1 lakh, that is rupees 60,000. So this 60,000 gain is definitely going to occur irrespective of the share price after 6 months. Alright friends, let us move ahead and deal with situation number 2. So what we have in situation 2, the price of equity share rises to 500 per share. Now what will happen in the stock portfolio where you hold a long position? Value today is 24 lakhs as described earlier, and value after 6 months this time will be higher. It will be 25 lakhs. So you will be making a gain of 1 lakh. But what would happen with the futures contract where you have taken a short position? You have agreed to sell at 492, whereas the prevailing market price on maturity is 500. So something which you have agreed to sell at 492 and the market price is 500, obviously you are going to incur a loss of rupees 8 per share multiplied by 5,000 shares. There will be a loss of 40,000. Again, 40,000 of loss and 1 lakh of gain. The net position would be rupees 60,000 of net gain. So we have proven one thing: no matter what happens, you will end up making a net gain of 60,000 in any case. Let's get started with question number 17. Let us read this question. An investor holds 1000 equity shares of X Limited that are presently quoted at rupees 200 each. The beta of this share with respect to the index is 1.25. A contract of 3-month index futures is quoted at rupees 4,000. The contract size for index futures is 50 index per contract, and the investor does not have a possibility of entering into fractional contracts, and hence the investor decides to take up either 1 or 2 contracts. Indicate the position of the investor in terms of gain or loss for both the situations, that is 1 contract and 2 contracts, if the price of the share declines by 20%. Also specify whether it is a case of under hedging or over hedging. So friends, before we start solving this question, let us first analyze what all is given. So first of all, we have 1000 equity shares held by the investor. These shares are currently priced at 200. So 1000 multiplied by 200 will be the value of stock portfolio. Beta of that stock with respect to index is already given, so we don't have to determine beta. Then beta multiplied to this stock portfolio value will give you the desired value of index future portfolio where the investor should take a short position. We know that very well. Index future price is directly given, so we don't have to bother about determining fair future price of the index. But there is a limitation over here. You have only 50 index per contract. So if the number of index desired by the investor is anything which is not in multiples of 50, the investor will have to either plan an under hedge position or an over hedge position, and that is what we have to learn through this example. So let us see how to present the solution, and the initial part of calculation will be same as you have seen in earlier question. So let us begin with the solution. In the solution, the procedure begins with determining the value of stock portfolio. That is the first step, and that is rupees 2 lakhs, 1000 shares multiplied by rupees 200. Then the next step will be to determine beta, which is already given in the question informed to you directly. Now third step will be the desired value of index futures portfolio. We have always discussed one thing, that in order to create a perfect hedge, the hedge ratio must match with beta, and for that purpose the desired value of index future portfolio will be the value of stock portfolio multiplied by beta, because beta has to be matched with the hedge ratio. So that will be 2 lakh multiplied by 1.25, that is rupees 2,50,000. So the investor should take a short position with respect to this index future portfolio. Alright friends, you would have finished writing this much. Let us move ahead. After these steps, we would now determine the number of index futures to be contracted. So step 4, determine the number of index to be contracted in the futures market, and number of index will be the desired value of index futures portfolio divided by quoted price of the index futures. So what we get is 62.5 indices. So the point now here, this is going to create a problem, because there is a limitation that you can take the contract in multiples of 50 index each contract. So the investor can either take one contract that will be 50 index, or the investor can take two contracts which will be 100 index. So 62.5 is not possible. So 50 index, that is single contract, will give you a position of under hedging, and two contracts that is 100 index will give you the position of over hedging. Alright friends, let us move ahead and see what we have to do now. Starting with stock portfolio that is with long position, what we have, value today is rupees 2 lakhs as we have already discussed, and value after 3 months is expected to decline by 20%. So value after 3 months will be 2 lakh minus 20%, that will be 1,60,000, which will result into a loss of rupees 40,000. So we have an expected loss of 40,000. So what we do now is we link this with the fall in the index future price, and we have learned one thing: percentage decrease in index will be percentage decrease in stock divided by beta. So 20% divided by 1.25, the percentage decrease in index will be 16%. Therefore, index future price expected after 3 months will be 4,000, which is the current price. You can see this is the current price and this is the expected decline. So the expected price after 3 months with respect to the index futures will be rupees 3360. So what is going to be a trouble for us over here? We will not be able to plan a perfect hedge. If we would have planned a perfect hedge, then this resulting expected loss we would have knocked off by the gain in the index futures contract of exactly same amount, 40,000. But this time it will not happen, because to do that the hedge ratio must match with beta, and this time the hedge ratio, the desired hedge ratio is 1.25, which requires 62.5 index. But we have two possible scenarios: either take 50 index or take 100 index, that is a single contract or two contracts. So let us see how to present that part of the solution. So case 1, one contract that is 50 index, value of index future portfolio will be only rupees 2 lakhs. You can understand one thing very well, because one contract is 50 index and current value is 4,000 per index. What will happen? The index future contract that we should have planned for perfect hedge was rupees 2,50,000 as determined in step 3, but we are forced to undertake a position of only rupees 2 lakhs. What will happen? Index future portfolio where we have a short position, the price of index future after 3 months we have just determined in the earlier working, it will be rupees 3,360, and the price at which we have taken short position, that is contracted sale price of index future, is rupees 4,000. Because we have agreed to sell at 4,000 and on the settlement the expected price is going to be lower, we are definitely going to make a gain. Gain per index will be 640. Now just imagine if 640 would have been multiplied by 62.5 index, we would have got exactly 40,000 of gain, which would have knocked off that loss of 40,000. Unfortunately, we don't have any chance of taking 62.5 index. So case 1 is just 50 index. So number of indices contracted will be 50 and the resulting gain will be 32,000. So what do we identify? That against a loss of 40,000 we are able to hedge only to the extent of 32,000. That means there will be still a resulting loss of 8,000 on a net basis, and that is what we are calling as under hedging. So friends, please carefully note down this part of solution and then we move ahead with case 2. Alright friends, let us move ahead and let us take up case 2. So case 2 is with two contracts which gives you a short position in 100 index futures. So value of index future portfolio this time will be rupees 4 lakhs. Index future portfolio with short position, the price of index future after 3 months remains same, that is 3360. This will not change, and the contract price for sale, that is The price at which we have taken short position is 4,000. So you can see gain per index continues to be rupees 640. That will not change. But this time the number of indices that we have contracted are 100 index, and the overall resulting gain will be 64,000 through index future contract. And what we can see now, against a loss of 40,000, we have hedged in excess, and this is what we are calling as overhedge. Friends, don't take a false impression that overhedge is always good, because if the price moves in the opposite direction, overhedge can be a troublesome thing. So the best thing what we should try doing is plan the hedge in such a way that hedge ratio should match with beta. Alright friends, you would have finished writing this whole thing, and now the solution is completed over here, but let us note down something very important. Please take note of what you see on screen now. Hedge ratio will always be the value of index future portfolio divided by value of stock portfolio. So the desired hedge ratio in our case was 1.25. I told you this should match with beta. That is what we desire, that is what we aim at. And what has happened in case 1 and case 2, you see in case 1 the value of index future portfolio was 2 lakhs, value of stock portfolio was also 2 lakhs, the hedge ratio was only 1. So the desired hedge ratio is 1.25, and if the actual hedge ratio is only 1, obviously it is going to result into under hedging. And what happens in case 2? The value of index future portfolio is 4 lakhs against the stock portfolio value of 2 lakhs. That means the hedge ratio is 2 times against the desired hedge ratio of 1.25 times. Obviously this is a case of overhedging. So case 1 is the case of underhedging, and case 2 is the case of overhedging. Alright friends, so let us move ahead and write down the last concluding point. If hedge ratio is less than beta, it results into underhedging. If hedge ratio is greater than beta, it results into overhedging. If hedge ratio is equal to beta, it results into a perfect hedge. Let's get started with question number 20. Let us read this question first. Question says BSE 5000. Now BSE stands for an index, that is Bombay Stock Exchange. Obviously this is indicating index. One thing to notice is they are not talking about futures. It implies that this index must be the current index value. Anyway, value of portfolio is given as 10,10,000. Risk-free interest rate is given as 9% per annum, and dividend yield on index is given as 6% per annum. Beta of portfolio is given as 1.5. Obviously beta must have been given with respect to this BSE index. We assume that future contract on BSE index with a 4 months maturity is used to hedge the value of the portfolio over next 3 months. One future contract is for delivery of 50 times the index. Based on the above information, calculate price of future contract and the gain on short futures position if index turns out to be 4,500 in 3 months. So friends, let us first try to analyze the entire situation. First thing first, they have given you the current index value, they have given you dividend yield on index, risk-free rate of return, and they have also given you the time required for the maturity of index future contract. And therefore, through the current index value, you will use FFP concept and determine the futures price of the index. That is one thing which will be the answer for the first part. Obviously, your portfolio has a positive beta with the index. For the purpose of hedging, you should definitely take short position, and that is what given over here. You would have taken short position in the futures contract. But one thing worth noticing in this question, your objective of hedging is only over next 3 months, but the index future contract will mature over 4 months time. So how would we initiate the entire procedure is worth understanding in this question. So let us see how to present the solution. In the solution, you will obviously begin with your usual procedure, and where the first step is determine the value of stock portfolio at present. So your stock portfolio value is already given to you, that is 10,10,000. And now step 2 is to determine the beta of such portfolio with respect to the index, and beta of that stock or that portfolio with respect to the index is again already given to you. Now what you have to do to create a perfect hedge ratio should match with beta. You have learned that already, and now what you have to do, you have to simply multiply the beta, which is eventually going to be the hedge ratio, to the value of stock portfolio to identify the desired value of index future portfolio which you should enter into with a short position. So third step will be determine the desired value of index future portfolio, and that will be value of stock portfolio multiplied by beta, that is 10,10,000 into 1.5, that gives you rupees 15,15,000. Alright friends, ahead in the solution, what we need to first determine is the futures price, the fair futures price approach we have to follow. So let that be the next part in your solution, 4-month future price of the index. Now we are going to use this 4-month index future for hedging the stock, and that is why we are aiming at determining the 4-month futures price of the index. So how to do this? In the question we have been given dividend yield on the index, and dividend yield on index is given as 6% and risk free interest rate is 9%. Now if you remember, for determining fair futures price, this is the third situation where the index or any instrument is providing you a constant yield, which is 6% in the given case. However, because there is no continuous compounding being applied, we are simply taking r minus y, and r minus y is multiplied to the time factor. So when this whole thing is multiplied to the current index value, this whole part will become the interest adjustment, and this interest element added to the current index value will give you the futures price of the index. So let us find it out. This will become 5,000, and this whole part is exactly rupees 50. So the futures price of the index is turning out to be 5050 over 4 months. So price of one futures contract, if you look into another point given in the question, the contract size is 50 index per contract. So one future contract will have price of 2,52,500, that is the cumulative value of 50 index futures included. So next step, step 4 will be the number of contracts that you should enter into, obviously with short position. So number of contracts will be the total desired value divided by price of one futures contract, and this results into 6 contracts. Alright, moving ahead, what we need to do is we need to find out the futures price on the settlement date. One thing that we should never forget, that we have used a 4-month futures contract to hedge the stock portfolio over 3 months. That means at end of 3 months, if the index value is 4,500, there is yet one more month remaining for maturity, and therefore the index future will not settle at 4,500. We will have to indeed find the index future price that would prevail on this date, with the fact that the remaining maturity is still 1 month. Therefore we again use FFP approach. So this is the current index value. On this we add 1 month interest component, that is 4,500 the current index, into r minus y, that is risk free rate minus the dividend yield, multiplied by the remaining maturity, that is just 1 month. So 1 by 12 multiplied, this whole thing becomes the interest component. When added to the current index price, what you get is the index future price. Now once you get index futures price, you can easily determine the resulting gain. Let us understand how to find that gain. So 5050 is the price at which we have taken short position, and on settlement the index future price is 4511.25. So we have agreed to sell at 5050 and it is on settlement 4511.25. Obviously, difference between these two will be the gain made for each index future. 50 is the number of index per contract, that is the contract size, and 6 is the number of contract. When you multiply all this, what you get is rupees 1,61,625, which indicates gain from the short position. So you may take note of this, and that will be end of the solution.